Aloha, my friend. We're looking at simulated trading account. Let's see, a little management now. Friday night, almost 8 o'clock. Look at that. No futures, no future contracts open. You know why? Because look at this right here. Closed out 70 bucks. Opened this up for 170. Bought it back to close the position for 100 bucks and profited $70. It's possible that maybe I could have made a little more, but it's all good. I'm totally happy with making 70 bucks on it. That was a plan, so I just went with the plan. Now this one, Amazon, Microsoft, Netflix, Nvidia. These are all naked call options that have an expiration date sometime around 2025. Maybe one is 2024. And at 1 minute and 30 seconds, a link is going to pop up here to a video selling options with the VIX. Part 2. It'll link to part 2. Part 2 will link to part 1. Watch them both and you'll see me originally put on some of these positions. You get an idea of how you can do that strategy. So right here, boom, it just popped up. 1 minute, 30 seconds. Feel free to come back and watch that, right? That's why I'm repeating. 1 minute, 30 seconds. Wait till this video is done and then come back to 1 minute, 30 seconds and watch that. Right, so the Amazon one, that's profitable by 70 bucks. The Microsoft one is profitable by 60. Netflix is down a little less than 800. Nvidia down about 170, and SPX is actually a call credit spread, and that one is profitable a little less than 2,000. So this SPX, Nvidia, Netflix, Microsoft, and Amazon, that were all sold with that strategy you can see at the 1 minute 30 second mark. With hindsight, I would have closed out all of those already. There was one time this one was profitable by about 2,600, 2,900, somewhere in there. I probably would have closed them all out. But it's a learning process, right? It's paper trading. That's how you learn. Now this one right here is a strangle. Do you know what a strangle is? Let me quickly explain what a strangle is. So we have this strangle with long dated, right? Using leaps, these long options. And that's closing January, expiring January 2025. But we have our strike price of wherever our current strike price is. Right now it happens to be right here, a little less than 180. So a strangle is you sell -1, you sell a call, and you sell a put. One, like up here, if your price is in the middle, you got a call up here and a put down here. That would be a strangle. Have you heard of a straddle? The only difference between a strangle and a straddle is instead of selling a call, selling a put, you buy a call and you buy a put. Now, regardless of how you start this off, right? If you started off as a strangle or a straddle, you could adjust this into an iron condor, or you could adjust it into a variety of things. Like, how would you adjust it into an iron condor? Well, if you had bought a put and bought a call, then you could also sell a call and sell a put. Same expiration date, same underlying, just a little different strike price. That will turn it into a iron condor. Or maybe you just decide, like in this case, right, the part that's moving into trouble is the call side, because we're creeping up towards 200. My strike over here on the call side is 300. So maybe I can just turn this side into a spread. So however you want to do it, you can do it. Maybe it's not however you want to do it. Maybe it's however you either gonna lose less money or make some money when you're adjusting. Apple, did I already tell you? We'll talk about this one in a little while because that one is kind of under the most amount of pressure. Short stock, still got that share of the S&P 500 open that I don't even know why I shorted it. I think it was for some explaining something in the video, but I just leaving it open. No open orders. Right here though, I have this open order on Walgreens actually, but no open orders under that tab. What I'm trying to do is sell a cash secured put option on Walgreens. See this mark where it says 0.065? Trying to get filled at 10 cents. So I'm just letting this linger. Let's see if Walgreens is going to drop down a little bit, get filled at 10 cents. With a strike price of 30 bucks. So right now, it's currently traded a little less than 36. So in order for me to get filled, it needs to drop down, or just for some reason volatility needs to increase and give me an extra $4 here instead of $6.50. Give me 10 bucks. And why am I okay with just making 10 bucks? Well, because in this paper trading account, I want to buy Walgreens, but I don't want to buy it here. I want to buy it at 30 bucks. Seems to be a better deal. But not much I have to manage for that, right? H&R Block. I have H&R Block and Cal-Maine Foods, right? No days left. Right? Today was the expiration date. January 20th, January 20th, January 20th. And look what happened. We got a strike price of 50. It closed today at 54. This contract is expiring worthless. Strike price of 37. This closed at 37.44. This contract is expiring worthless. So, as a stock insurance salesperson, I brought in 30 bucks, 40 bucks. I'm just keeping the money with no need to fulfill these commitments. What commitment am I referring to? Buying 100 shares of Cal-Maine at $50 per share. Buying 100 shares of H&R Block at $37 per share, which I'm 100% happy to do, but no need to do it, right? So very little maintenance needed on these, right? We talked about maintenance on the strangle in case I might need to put some maintenance on the strangle. Maybe at some time I might need to put some maintenance on these over, not really so much on this one. I could, right now, this is a call credit spread. So that means I have shorted a call and I bought a call, right? Shorting the call brings me in premium, and this is buying protection. So as long as SPX stays away from this basically 46,000, 4,600, sorry, 4,600, I'm probably going to end up closing this out at a profit. And all these that I talked about with selling options with the VIX, they all have these limit orders set up to close them out at half the amount of premium that I brought in. So this one, you know, maybe at some point, maybe I'll need to adjust it. I could roll these into a longer strike price, or I could turn this into an iron condor, or just sell a put or something like that, right? So I could say I turn it into an iron condor. Then I'm going to sell a put. Right, here's our strike prices in between. Buy a put. So I might have to do that. Possibly I might have to take the time to take Netflix. Maybe have to turn this into a credit spread, because right now, right, our price of Netflix is trading at $343.80, and I got this 550 sold here, 550 strike call. So you got -1. Maybe I turn it into a credit spread by buying some protection up here to adjust it. I don't know, at like let's just say 600. I have no idea if that number really works out. I'm just showing you that you would buy some protection up here. So instead of having this huge risk of needing to, because basically what happens if Netflix goes over, at any time, actually, I could be called to account. Someone might say, hey, sell me 550 shares, excuse me, sell me 100 shares of Netflix at $550 per share. They could do that, but they could do that anytime before this contract expires. But they won't do it right now because they could just buy it for less, right? If they're going to buy it from me for $550, I'm going to buy it here, and I'm gonna make money. So I wish they would do that, but they're not going to do that, right? They're really probably only going to want me to sell them these shares if Netflix is at, like, let's say, I don't know, 700. If it's at 700, then yeah, of course they'd want me to sell it at 550 to them. They buy it at 550, they can turn around and sell it for 700, instantly make a profit. So so that's why I'm not worried about it until closer to the expiration date. But you know, so my risk is pretty big right now, right? If coming to that expiration date, $550 per share times 100 shares. So I'm on the hook for $55,000 here. Now if I turn this into a credit spread, I'm only on the hook for basically the difference of 550 and 600 is 50 bucks times 100 shares. Right? 5,000. Taking a loss for 5,000 is a lot better than taking a loss for 55,000, right? So that's basically like why you know, what maybe that might need to be adjusted, right? But these down here, look, I'm not adjusting anything. Why am I not adjusting anything? Because at contract expiration date, right, I've got commitments to keep here, but I don't have the money to keep those. Or I guess I kind of have the money, but I don't really want to. I don't really want to fulfill those commitments. I'm getting paid to make promises, but I want to adjust so I'm legally getting out of my commitments instead of fulfilling that $55,000 commitment on Netflix. I don't want to do that. I want to not pay any money to fulfill that commitment. I want it to expire worthless. If it's not going to expire worthless, I want to spend the smallest amount of money possible to fulfill my commitment. But over here, different story, selling cash secured put options on stocks that I don't mind owning. On here, what's my commitment? My commitment is buying the stock. Right? If I sold a naked, this is a naked call option, but I could just as easily sell a naked put option. That means instead of selling the stock at a certain price, I'm saying I'm going to buy the stock. Well, I wanted to buy the stock. So when it comes to contract expiration date, no days left, I'm not worried about it. I'm totally okay with buying 100 shares at 50 bucks. I want to own the stock. I'm going to get paid to wait. That's really the beauty of this. And over here, there's a link to this website in the description below. You can download this cash secured put stock selection guide, 3 stocks I sell cash secured put options on. You can download these also. These aren't as relative to selling cash secured put options, but although number 3 will definitely put you in a different, number 3 of this will definitely put you in a different financial situation if you have the drive, the willpower, the discipline to implement number 3. I don't know if you got it. Most people don't. I hope you do. Just going to be honest with you. And it's not some reverse psychology. It's just the fact that the majority of Americans do not have what it takes to implement number 3. Maybe 50 years ago, maybe 100 years ago they did. The majority of Americans now have the attention span of TikTok, and I know you're not that person, but I'm just calling a spade, putting on the table here that number 3 is not easy to implement. But if you do implement it, your life will definitely be different. Now these 2 up here though, specifically on selling cash secured put options. Also in the description of this video, there's a playlist, Trading Options for Beginners, with beginners in all capital letters. With these 2 downloads and watching that 5 video playlist, you'll be in a position to be paper trading, selling cash secured put options. Get yourself kind of familiar with it, feel out some stocks, see which ones you want to which ones you might particularly like owning, what would be suitable for you. Use a paper trading account to figure out what's suitable for you, and then from there, when you're ready, you can move into real money after you feel like you got that dialed in, and then you continue to use your paper trading account for like selling naked options with the VIX back at the 1 minute and 30-second mark. But that's what I would start with. I would start with selling cash secured put options on stocks I don't mind buying. And one reason why, like I'm saying, is that no matter what happens at expiration, you're in a good situation. Now I was talking about Apple, so let's take a look at Apple. Right now we're looking at a 2-day, 5-minute chart, and we're gonna look at some other charts too. But normally, like, this is my day trading chart, and it just happens to be that when I click charts, it's up, and it happened to be that Apple's on here. So that's why we're looking at this. No particular real reason, but so over the last 2 days, we see that Apple hit this high of 138.61, right? And where it created this little bit of resistance right in here, and we're kind of touching that, but a little lower. It's debatable. Could you say, well, that's a high, that's a lower high? It's debatable. Are we just are we saying that because is that actually significantly lower, or is it still in that range, or am I just saying it because I want Apple to go down because I got this naked call option up here? So let's look at, right now we're looking at a 6-month daily chart, right? This is highest has been is 175. Our sold call is at 150, right in here. Bring this over here. Sold call at 150. Now right now, here's on that 15-minute chart, we saw it got up to there. And so far, right, it seems like this 135 that was acting as a bit of potential resistance right here. Now it's on the upper side of this, and it seems to be acting as support. You can see that, right? And how many days do I have left on this contract? 13 days. So what I'm going to do, I'm going to go over here. This cone of probability. Over on this side is the dollar amount. Down here is the date. So 13 days, what's the actual expiration? February 3rd. So February 3rd, I'm moving to February 3rd. Okay, right, look on the bottom of the screen, you see 2, 2, 3. Now I'm gonna lower this down to 150. February 3rd. Okay, well, according to the cone of probability, there's statistically it's not likely, right? This is on a cone of probability right here. You see that 68%. February, was it February 3rd or February 2nd? I can't remember. But we see that 150 is falling outside of the cone of probability. Okay, so that's good to know. Let's move back over to that daily. Okay, so we see our resistance here, and we see in the past, like, resistance happened here at this 140, or support, right? Support happened right here. See it kind of happening right here. In this whole area, it's kind of clumping from like 135 to 140, a little bit over 140. What is that? Is that like 142 or 143? We see it right in here. So it's kind of like this range right in there. And then also we can see right in here, that's the $145 mark, right? We see in the past prices kind of clump up around there. Look at this right there, hitting that 145. See it right there, kind of happening right there. So I've been just kind of watching. I see it's moving in, like, seems to have some support and resistance in $5 increments. So I'm watching it, and I have been watching it right from here when it started going into this 130, right? What's it going to do from 130 to 135? Now I see what it's doing from 130 to 35. Now the next part I'm going to watch is from 135 to 140. And then let's look at the weekly. So the weekly is, I want to take that off. Hold on one second. Over here, click equities. What am I looking for? Maybe it's under general, right? Show orders. I want to take that off. Okay. So I remove that. I want to have a cleaner view here. So we got this. We got a pivot right here on the weekly. This candle. Today's Friday, so it totally closed. We see. Let's move this in just a little bit. See, we got this pivot low right here at around 125. Prices last week really moved up pretty powerfully. Seems to be some slowing momentum. Volume really fell off this week. Our naked call is here. Now, if next week, because basically we got about 2 weeks left on this contract, right? 13 days. And then, so roughly about 2 weeks. Maybe once Monday hits, it's going to be a little less than 2 weeks. Not exactly sure, but you know, just to kind of make it easy, let's say about 2 weeks. So if through next week, if it starts getting around this 145, right? If it starts hitting, if it seems like it's going to be hitting resistance around the 145, then actually before we do that, let's look at the monthly. Again, I want to take that off there. So, and so you know what that is, I have this right here that was showing this order, right? I have this order to close it out at 10 cents, right? I brought in 35 cents to sold to open for 35 cents. I want to buy to close for 10 cents. That's what I have on here right now. Whether or not it'll give us the opportunity to, and because it's kind of like market prices, 44.5. We're in the negative by $9.50. Not too big of a deal. With this, I'm really practicing selling a naked call and turning it into a covered call. So more on that in a moment. All right, so we see our right here. Where's our? Go down here. Put this horizontal thing. Where's our 150? About right there. So I see here in the past, for some reason, it's dropping down at 150. Right in here, it's about from like 149. Where's that? 153. Where's this one? 150, 151, almost 152. Where did this drop down at? 148. So, you know, I see how on the cone of probability, right, that at this date, on the 3rd, 150, it's lying outside of the cone of probability, but it's close. And a lot of times that's how, I don't know, sometimes that's how I like to do it, is just like try to get as, you know, just try to have it right outside of the cone of probability. So going back, looking at the monthly. Now, something else we can look at here, if you watch some of my the like daily chart review videos, talking about when you have this big drop, right? So I look at this candle. Now this is a monthly candle, so we're just basically not done with the full month, but this is December here. So we have this big drop, and so far, even though this candle is not closed, we're still in the bottom. We're still in the bottom half, bottom 50% of this big drop right here. And right through here, I see it has this range of just resistance right in this area, and that must be about 140. Right in there. Yeah, 140. Now, whether it's a little bit lower down here to 135, whether it's like a little higher up here, it's like something in that 140. So, you know, on our daily chart, let's look let's look at the weekly, since that's the next one over this way. On our weekly chart, and zoom back out. On our weekly chart, we see it kind of keeps getting close to 140. Got up to what was the high? Got up to 138, pulled back, couldn't even get back up to almost got up to 139, right? 138.61, pulled back. What's the highest it got to today? The highest it got to today, this Friday, was 138.02. So it's like it really seems to be hitting more resistance around that 140. And so we see this on the weekly chart too, right? You see that, and going back to our daily chart. So I'm still sticking with the same game plan, right? If it cuts through 140 like butter next week, and it really starts testing or seeming like it's going to break this 145, I have to kind of look at the candles. I want to look at the volume. Today, I had a lot of volume today, right? Not much volume yesterday. We really had some volume come in. But what's next week going to look like? When we looked at that weekly chart, the volume, like low volume on the week, what this would tell me is like this week, even though prices moved up, look at the difference in the volume, right? There was neither of the last 2 weeks are touching the average volume, and this week it's a lot less. So it's like I don't know how much power there is to push up when you have a stock and you're wondering whether you want it to or not to break through resistance. It needs some power. Generally, it needs some power. Now, if we had volume bars like this, then I'd be thinking it has a lot more chance of pushing through that upside. But most of our volume bars here 1, 2, 3, 4, 5 days of trading. This is 1 week of trading right here, and on Friday we just finally get some oomph, so it even touches the average volume of 50 days. Everything else has been weak, even going back. So you got 1, 2, 3, 4, 5. 1, 2, 3, 4, 5, right? So for the most part, in the last 10 trading days, it's just been weak, like weak volume at least, right? It's moving up kind of on weak volume, and that just sort of makes me feel more confident that I think things might fall into this cone of probability where the 150, I think I have a better chance of it expiring worthless. Now, let's say if it's getting close to expiring worthless, I'm just closing it out at 10 cents, right? That's really, I have that limit order set. I'll close it out at 10 cents. That's no problem if it happens. What's going to be more of a problem, and why I need to watch it a lot more, and this is kind of why I like selling cash secured put options on stocks I don't want to own, because I don't have to sit here and finagle all of this, right? If it was like if I sold a cash secured put option at 120 and it's getting ready to break below 120, what do I care? I'm keeping the premium and I'm buying 100 shares of Apple at 120, right? That was my plan. But this is not. This is something different, right? So that's why I think selling cash secured put options on stocks that you want to own is a strategy that you should learn so you can implement it whenever you need to. You're going to go on vacation. You're going to be gone for a month. You don't want to be trying to manage this stuff, especially if you don't even know if you're going to have an internet connection, right? If you're not going to have an internet connection, just sell cash secured put options on stocks you don't mind owning at strike prices you're happy to buy them at. So, all right, so if it just starts fizzling out somewhere between 140, 145, it's just kind of losing momentum, and then as I get closer to contract expiration date, what happens is that the value of this, the time part, right, the theta part. So there's the stock option Greeks, which, speaking of stock option Greeks, if you want to have a one-page cheat sheet right here, you can download that for free. It'll basically give you a one-sentence definition of all the stock option Greeks. You can just have them for a quick reference. But theta is the Greek that represents the time value of the option contract. So the nice thing about selling options is that no matter who gets on the TV or who's in front of you or who's on social media, no matter what anyone says with 100% confidence, there's only one thing that we know with 100% confidence that will happen in the stock market. And that's right here. Its time is going to pass. So every day Apple stays below 150. This contract, when you look at the Greeks, it's losing value to theta. Now it might be maintaining some value because of volatility, or it's getting closer to the strike price. You know, it's kind of like it's a mixture of things that go into option pricing, theta being one of them. So if Apple starts kind of just kind of like staying below 140, but peaking above a little bit, 140, 141, 142, and then pulls back to like 139. Probably at some point as we get closer to this contract expiration date, then the value of this will start dropping, and I'll just close it out at 10 cents. Right? So that's going to be my ideal situation. Now, what if that doesn't happen? Right? If it doesn't happen, I'm going to have to make a decision sometime before 150. And that decision is going to be, when am I buying 100 shares? Am I going to buy 100 shares at 145? Am I going to buy 100 shares at 148? Am I going to buy 100 shares at 149.50? You know, maybe I will buy it at 149.50, and maybe I set up a limit order, or yeah, I forgot. It's a limit order. I'm not sure what type of order. I'll have to kind of look into that, and that's why I'm paper trading, right? I'm paper trading to you know, figure all this stuff out, and that's what you should be doing too. So maybe I can set up some sort of order that says like, hey, I want to buy 100 shares of Apple if it for no more than $149.50 if Apple is over 149. That way I turn my naked call, naked call into a covered call. And then if Apple goes over 150, then I keep my premium, that whopping 35 bucks, and I make how much ever money, you know, the difference. Now let's say if Apple doesn't go over 150, but I end up buying 100 shares at 149.50. So I hedged my position, but now I'm stuck with 100 shares of Apple. So one thing I could do is I could sell a covered call right at 150, right? And collect some premium. It'll probably might be a decent amount of premium. For example, let's say I sell a short. What's right now the current price is what, one? So if it's like 50 cents above here, so like 139, we get taken in about 140 bucks, right? So let's say that stays the same, roughly around the same. So I made, if that were to happen in theory, made 35 on the initial naked call option. Make say 140 on this premium that comes in, and 50 bucks on that, you know, buying at 149.50 and selling at 150. And because your good buddy Brent is not the greatest mental math person, oops, yeah, let's just do it this way. We got to add that 100 in there, right? So it took a potential naked naked call going awry, losing money, to possibly making 225. Let's just double check this. $35 on the premium for the naked call option, $140 on selling a covered call option, and then $50 for 50 cents per share, right? Times 100 capital gain. 225, right? Not too bad. But here's really what. Now there's two things that I'd really like to point out. Number one, this is pretty cool how you can adjust trades and you can take a loser and potentially, right? This is theoretical, but it's better than just sitting here biting my fingernails looking at how I'm going to lose money, right? I've got potentially can make some money here and not lose money. Take a loser and turn it into a winner because of adjusting, right? So that's pretty cool. But here's the other thing I really want to point out to you. You don't need to even do that if you don't want to. What am I adjusting on these? Unallocated. Hey, want some allocation here. Oh, they're unallocated because, yeah, they're closing them out, right? On selling cash secured put options on stocks that you want to own, no adjustments needed. You did all the adjustment before time. You figured out what's a good stock that you want to own. You did your legwork with a little fundamental research, and you just start selling. If you when I InvestTools used to be around, and one of the first InvestTools classes I went to, my first options trading class, my first stock market class was Rich Dad Options. But shortly after that, I went to InvestTools, and what InvestTools was saying is they said something like, with about like 80% of your money, right? If you got 100% of your account, 100%, with about 80%, you know, hey, you play with this number. You want it to be 60, you want it to be 70, you want it to be 80, whatever, you know. With about 80% of your account, you do these high probability trades, right? Low risk, low reward, but high probability of success. And with about let's say you can juggle these however you want to do it, but let's say with about 15%, or actually this is closer to my personality, with about 10% of your account, you do some high risk, high reward trades. And you got 10%. You know, I didn't learn this from InvestTools. I learned this from the Cash Flow Academy, the Mentor Club, and different courses through there with Andy Tanner and Noah Davidson. About 10% is just left in cash to hedge in case I need extra hedging. So what ends up happening is that this is your tortoise. This is your hare. Now this is high risk, high reward, right? So if this blows up, it gets wiped out. You still got this. You cannot blow up your whole account when you do this. The most you're losing is 10%, right? 10%. And you got 10% here just sitting on cash on the side. So for me, I like this sort of strategy. I like to have 80% of my portfolio doing stuff like this, right? Stuff that it's just like it's not get rich quick, but over time it's definitely get rich. And then with about 10%, stuff like that. You know, making that might not seem like anything, you know, really grandiose, making $70 in whatever it was. I forgot how many days that was. But that's one contract. Put on 20 contracts, right? If you're a baller, put on 20 contracts. Is that looking a little more exciting? Now, what's the risk though, right? So what happens a lot of times in trading is people focus on the wrong thing. They focus on this. That's why if you hear about people blowing up their account or losing money with options, it's usually because this is where their focus is. You know where your focus needs to be? Risk management. That's where your focus needs to be. Because this game, if you blow up, if you have zero money in here, you can't play. Then you have no choice. You're only in simulated trading. But unless you have a really, really driven personality, like a good buddy Brent, I've blown up my account more than one time, and I'm still playing the game. But you know what happened? A lot of those times when I blew up my account, all of a sudden I'm not talking about the stock market to people anymore. All of a sudden I'm not paying attention to it. It took time for me. The most recent time it happened was 2018, I think. Blew up my account, and I didn't totally blow it up, but I lost like about 60% of my value in 2 weeks. So you know, then it's like I'm licking my wounds, and it took me like several weeks, several months, something like that, more than weeks. It was probably a couple months before I started getting back into it, right? And why did I blow up my account? Because I wasn't following my rules. I was being greedy. I was focused on the money. That's why. I was focused on how much money can I make this week. I had a financial target in my mind that every week I wanted to make. And I was taking excessive risk. So really what was going on is, even though my mind was focused here, and that was good, but this is really what it looked like. This is really what was happening. I got to do it better for you than that. Oops. So my mind was focused on this, right? It's on top of my thinking. It's right there. However, what I was actually oh my good lordy, where is that at? It's so funny because when I have it over here, it was really, oh, there it is. What I was really doing is this. So my mind was was focused here, but this is the wrong focus, and because I was so focused on this, it grew this really big, and then 1 week, boom, I got hit. Next week later, I'm feeling a little panicked. I feel like I got to recoup those losses. Boom, 2 weeks in a row, basically selling credit spreads, weekly credit spreads, where I was not at all focused on the risk. And because I was only focused on the money, on how much premium I was bringing into my account, it grew my risk really large, and I was ignoring my own trading rules and risk management rules. And it was like week after week after week after week after week. I mean, it was working. And that's what I heard about selling credit spreads. It's like, or selling options a lot of times. Like when you take in on this big risk, they say it works until it doesn't. And when it doesn't, you lose big. And that seemed to be true. That 100% happened for me. So if you are, you know, that's again why I just like this. I really, really like this. And it was one of that, losing about 60% of my account value in two different trading weeks in a row at one time in about 2018 is one reason why I really started thinking like, man, because at that time I was doing this particular sales job, And even though I was scheduled 5 days a week, I ended up working like 6 or 7 days a week. And it was very time consuming. And you know what? I live in Hawaiian Standard Time Zone, right? So I got these things against me, and this job was paying me really well. So I was up early. I was at that place, and I just couldn't put the same sort of management into it. So I was taking excessive risk. I wasn't putting, if I was just sitting at home on my computer, I wouldn't have blown up like that because I would have been managing the risk in real time. But I wasn't able to manage the risk in real time because I was out making money selling stuff. And I was making enough money that it made sense for me to be doing it. It was lucrative. So after that, I really started looking at like, sucks losing money. Really sucks losing money. Now, it was exciting making the money, right? Every week, seeing my account grow significantly. But then, after several months of having it grow, to have it go whoom and just drop down, right? 2 weeks in a row. So that's what made me really start getting focused on, there's one strategy that I can think of that, like, I don't lose. There's no way I can lose at option expiration date, right? There's no way I can lose. I either make the premium or I make the premium and I buy a stock that I want to own. I think of it as an income producing asset, right? Because I'm buying stocks that pay dividends. So that's my story. That's part of my story. That's what really has me passionate on this mission of spreading the word. Spreading the word. You have a bank account, you have an internet connection, you spend money at least once a year. At minimum, you got to be doing this. You're not doing this, you might as well just look at your kids and say, I don't love you enough. Right? That's really it. And I hope you're not the type of person. I hope you're the type of person that loves your family enough that you're willing to learn. All right? That's all I'm asking you to do. I'm just asking you to learn. That's it. It's for your own benefit. You guys have a fantastic day. I'm here as a resource for you. The only thing I won't do is compromise my own peace of mind for you. Other than that, you want to be friends, reach out. I love having stock market friends. You guys have a fantastic day. Aloha.